Welcome to the deep dive. Today we're cutting through the noise to look at a corporate document that feels, well, like a historical moment for the company involved.
We are diving into the third quarter 2025 earnings call for Tejon Ranch Company.
And this is a really big deal. Why?
Because this was the first quarterly earnings call they have ever hosted.
Ever.
Yeah. I mean, that alone signals a massive shift. They're moving toward transparency, trying to actually engage with the street, and they even took questions directly from shareholders.
And that engagement is desperately, desperately needed. You can just feel the pressure coming off this transcript.
Oh, absolutely. The stock's been bumping along a 52-year low.
Right, and that's all fueled by, decades of frustration over them not monetizing these huge, valuable land assets.
Exactly. So this call was really management's attempt to draw a line in the sand, detail a new strategy.
And that strategy is all about radical cost discipline and very disciplined capital allocation.
So our mission today is to figure out if they actually delivered on that promise.
Well, let's start with the headline numbers, because the immediate results, they gave investors a much-needed breath of fresh air. It looks like they stopped the bleeding.
They did. Tejon Ranch reported net income of $1.7 million.
Which works out to about 6 cents per share.
And that is a significant reversal.
Yeah.
I mean, compare that to the net loss of $1.8 million or 7 cents a share they posted in the same quarter last year.
That is a huge swing in profitability, and it doesn't look like it was just accounting magic either.
No, not at all. Total revenues were up 10% year over year, hitting $12 million.
And the operating income number was even better.
Right. Consolidated operating income surged 37% to $3.4 million. That's across all their segments.
So where did the CFO say all this good news came from?
He was pretty quick to attribute it to, strong performance across the board. Specifically, really strong farming results, stable returns from their commercial and industrial leasing, and steady joint venture performance.
But here's the kicker for me. The thing that really underlines this new mantra of discipline.
What's that?
Total costs and expenses actually declined.
Yeah, by nearly 5%.
Oh.
Which proves those efficiency efforts, they're already taking hold.
Okay, let's unpack this a bit. We need to get beyond the top line numbers and see what levers they actually pulled. Where should we start?
Let's start with the historic assets. Farming.
Right. The part of the portfolio that everyone sees as, volatile and weather dependent.
It was a powerhouse this quarter. Revenues were up by over 50% year over year.
50%, wow.
Which is exceptional. And they also managed to reduce the GAAP operating losses in that segment by 40%.
Okay, hold on. You have to help me with this. The company always stresses that farming is a reliable cash generator. I think they said it was positive on an adjusted EBITDA basis in 23 of the last 24 years.
That's right.
So if that's true, why are we still seeing significant GAAP operating losses, even if they were reduced? Is this just, creative accounting?
That's a crucial question and one a lot of investors ask. Management's answer is that the GAAP losses are mostly from non-cash expenses.
Like what?
So specifically the fixed costs tied to holding their immense water rights and some maintenance expenses.
I see.
So the strategic value of farming isn't just the cash flow. The fact that they're an active farming operation, that's what gives them the status to defend those water rights. And it lets them get low-cost debt.
So it serves a bigger purpose for the balance sheet than just crop revenue.
Exactly.
Okay, that makes sense. Let's move to what they're calling the nucleus of their operations, the real estate. Specifically, the Tejon Ranch Commerce Center, or TRCC.
The bedrock business. And it is rock solid. Their industrial portfolio is 100% leased.
100%, okay.
Commercial occupancy is at 95%, and the outlets at Taha, their retail center, held steady at 90%.
What stands out here and what you should really be focusing on is this sustained competitive advantage they keep mentioning.
The cost advantage.
Right. Their rents are climbing, but they still have a critical 40% cost advantage compared to the Inland Empire West. Why is that 40% number such a massive deal?
Because that gap is what makes TRCC, a permanent and sort of recession-resistant solution for logistics companies.
How so?
The Inland Empire West is just saturated and expensive. Tejon Ranch offers basically the same access to the ports, but at a 40% discount.
So they're the first call for any tenant looking to save money?
Precisely. They have pricing power because they're fundamentally cheaper. Yeah. Their occupancy holds up, even when the economy gets a little soft.
All right, let's talk joint ventures. The TA Petro partnership, that's their single largest earnings contributor, right?
It is. It brought in $1.9 million in equity earnings this quarter. But that whole segment also had a bit of a challenge.
Right. Overall equity earnings for the JVs were down.
They were decreased by 1.3 million year over year. And management traced that decline directly back to the TA Petro travel centers.
And the reason was what? Less traffic.
Simply less traffic on Interstate 5, fewer port shipments, less local commercial travel. It's a quantifiable problem.
And this is where it gets really interesting because management is counting on an outside force to solve this traffic problem for them.
They are. The imminent opening of the new $600 million Hard Rock Tahoe Casino.
$600 million.
Yeah. They're calling it a game changer.
I bet they are.
This huge investment is expected to be a massive traffic magnet. It should dramatically increase the number of cars on I-5, which flows directly to all of TRCC's retail assets.
The travel centers, the outlets, the restaurants, everything.
Exactly. It's a huge external catalyst funded by someone else that they get to benefit from immediately.
That leads us right into the broader strategy, because even with this good quarter, the CEO, Matt Walker, was surprisingly candid. He admitted the company is, quote, not yet where it needs to be.
Yeah, this was not a victory lap, not at all. It was a recommitment to change.
And the biggest, most concrete action they took was that workforce reduction.
A radical one, a 20% headcount reduction. That's across all levels of the organization.
And that one action alone saves them over $2 million a year.
It does.
Let's just put that in context. If they had $12 million in revenue this quarter, $2 million a year is about 16% of that recent quarterly run rate. That is a painful, aggressive cut.
It signals a true cultural shift, and it's clearly driven by shareholder frustration.
And the CEO made a point of clarifying something in the Q&A, didn't he?
He did. It was important. He explicitly said these savings came entirely from staffing costs, not from cutting external consulting fees.
Which was a direct shot at a concern from institutional investors.
A very direct response, yeah.
Okay.
They were worried management was just spending a ton on outside advisors.
Shifting to the balance sheet, how's the foundation looking?
It's actually very strong. They ended the quarter with $21 million in cash.
And debt.
Total debt is quite low, around $92 million. That gives them a debt-to-total capitalization ratio of only about 16%.
That's the whole paradox of Tejon Ranch, isn't it?
What do you mean?
A great low-leverage balance sheet, but the stock is in the basement. The problem isn't the debt, it's the assets that aren't working for them.
Exactly. And they spent a lot this year trying to get them working. Year-to-date, capital investment was almost $50 million.
And that was mostly for construction at Terra Vista and infrastructure at TRCC.
And, of course, the legal and permitting work for the master plan communities. They did offset some of that with about $5.5 million in reimbursements from the Community Facilities District, which is standard.
Okay, now we get to it, the core frustration. The reason the stock is at a 52-year low. The master plan communities, or MPCs,
The elephant in the room.
shareholders, rightly, are pointing out that Mountain Village and Centennial have a combined book value of over $290 million.
But they generate zero income. In fact, they actively consume capital.
So what was management's pitch to finally fix this?
Well, they conceded the point. They acknowledged the assets are significantly undervalued and are potentially worth much more than book value. The CEO said everything is on the table.
Meaning a sale.
If a compelling offer came in, they'd evaluate it honestly. But
the stated strategy is still to build them out.
yes, they argue that successful development will create decades of significant cash flow, just like their peers have done.
The risk there has always been dilution, though. How do they plan to fund these massive projects without burning their balance sheet or issuing a ton of new stock?
This is maybe the most important strategic nugget from the whole call.
Okay.
They plan to capitalize all future MPC development with a third-party joint venture partner who contributes all the new equity.
So let's break that down. Tejon Ranch puts in the land, the JV partner puts in the cash.
Correct.
So the company avoids issuing new shares, meaning no shareholder dilution. But doesn't that inherently dilute their ownership stake in those profits they keep promising?
It does, but it's a necessary trade-off. By doing it this way, they slash their risk, they save their cash, and they get the expertise of an experienced developer.
And given the shareholder skepticism, avoiding an equity offering is probably the #1 goal.
I think it has to be. It's just capital discipline, even if it means splitting the pot later.
So what are the timelines here? Let's start with Mountain Village.
It's a long haul. The CEO laid it out. They need to spend the next year just on a capital raising effort with that JV partner.
1 year just to find the money. Okay.
After that, you're looking at 18 to 24 months for construction documents. Then another 24 months just for horizontal infrastructure.
Roads, sewer, power.
All of it. Before the first home site sale even begins, you're looking at minimum 4 years before capital starts coming back.
And Centennial is even more complicated.
Oh, significantly. Centennial needs a major re-entitlement through LA County first. Management thinks that approval process alone could take until the end of next year.
So the timeline there is much longer and less predictable.
Substantially.
There was a really crucial accounting detail you, the investor, have to understand. Management made a key distinction about profitability.
Yes. This is so important. While the entire MPC project is expected to result in a material book profit,
Over the long term.
right, the initial phase of development is absolutely not likely to generate a book profit.
That sounds confusing. How can a project be profitable overall but lose money at the start? Give us the simple analogy.
Think of it like building a skyscraper. The whole tower is profitable once you sell all the units.
Okay.
But that initial phase, digging the giant hole, pouring the foundation, running all that expensive infrastructure, those activities are 100% cost and zero revenue.
You can't sell a sewer line.
You can't sell a sewer line.
Yeah.
It's only after that foundation is in that you can start selling the valuable parts. So the initial phase is a guaranteed capital burn. Investors have to factor that in.
That clarity is essential. Okay, so to wrap up the strategy, the CEO ended by confirming where their capital focus is today.
It's the TRCC platform. The vast majority of their capital over the last 5 years has gone into expanding TRCC. They know they have to keep investing in the assets that are actually making money right now.
And part of that is more housing. They confirmed plans for more multifamily and single-family homes around the Commerce Center.
And they are specifically leveraging that Hard Rock Casino opening to do it. They're actively trying to attract casino employee demand for the 228 units they just finished at Terra Vista.
So the casino isn't just a traffic catalyst, it's a direct driver for rental demand.
They're connecting the dots.
Okay. We always have to remind you, this is the deep dive. We're professional summarizers of transcripts. This is not financial advice.
But we do enjoy putting on our hedge fund analyst hat and pitching an outrageous but plausible trade idea based just on the details we covered.
So the current negative view on the street is all about the multi-decade failure to monetize that land.
Right, which creates short selling pressure. Our trade idea completely ignores the slow, long-term MPC timeline.
And it focuses purely on the immediate, tangible, non-land catalyst.
The thesis, go long to home ranch, based purely on the impending catalyst of that $600 million Hard Rock Casino opening.
And specifically targeting the highly leveraged TA Petro joint venture earnings.
The mechanism. The best way to play this is probably to buy out-of-the-money call auctions expiring shortly after the casino's official opening date. It's a low-cost, high-leverage bet.
And the bet is that the immediate visible spike in I-5 traffic,
A metric that's easy to quantify and has nothing to do with the MPC.
will shock the street and immediately boost the TA Petro earnings, which are leveraged to every single car that drives by.
And that forces analysts to revise their discounted net asset value almost instantly. It's basically a traffic proxy trade.
To summarize this deeply interesting first-ever call, Tejon Ranch is directly addressing its past failures.
They're doing it through radical cost-cutting, that aggressive 20% headcount reduction.
A dramatic increase in transparency and a defined strategy for the MPCs using third-party JV equity to avoid dilution.
So the overarching question for you to consider is this. Given the extreme shareholder pressure and management's promise that everything is on the table, and knowing the Mountain Village timeline is 4 years minimum,
And Centennial is even longer.
if that critical joint venture capitalization strategy stalls in the next 12 to 18 months, what specific non-TRCC asset is the most likely candidate for a partial or full sale to generate immediate cash?
Is it the stable but capital-consuming farming operation?
Or maybe a portion of their highly valuable, irreplaceable water assets?
Think about the strategic implications of that choice. We remind you again, this has been an analysis of a corporate earnings call transcript. It is not financial advice.
Thanks for diving deep with us.